Chapter 13 is all about depreciation, and let's figure out what it is. So every non-current asset a business owns is used to generate revenue. So taking the example of a delivery van that we're going to own for 3 years, each year we're going to use that to make sales to customers and deliver them to them, and we're going to earn $25,000 of revenue. So in the second year we've earned $25,000 of revenue, and in the third year $25,000 of revenue. But we can't earn revenues without incurring an expense. So what we need to do is figure out the expense of using the van, and we're going to call that depreciation. It's going to be the allocation of a cost of a non-current asset over its useful working life, and each period it represents how much of the asset was consumed or used up to earn revenue. So how many economic benefits did we use up to earn the revenue? So taking the example of a $10,000 car that's going to be used for 5 years, we're going to use that car to earn revenue every year, but we're also going to consume some economic benefits, and that's called depreciation, and that's an expense. So in year 1 we've got a $2,000 expense, year 2 a $2,000 expense, again in year 3, 4 and 5. And what we've got is each year the amount that we've consumed in economic benefits of $2,000, and that's written off as an expense called depreciation. And looking at it as a graph, we could see that after 1 year, $2,000 of the car's economic benefits have been consumed. So we can see they're gone, and once they're gone, that's an expense. That leaves the unused portion of economic benefits, so the benefits that haven't been used yet, of $8,000. So if a benefit hasn't been used, it'll be used in the future. That must be an asset. And as you can see, over time, we're just using up $2,000 more each year, and that leaves less of the asset to be consumed in the future. So after the 5th year, we'll actually have used up all of the asset's economic benefits, and the total $10,000 would have been depreciated. Looking at 2 alternative treatments, well, what we just did in the first treatment above was we matched, say, $8,000 of revenue from using the car with $2,000 of expenses. Well, why didn't we just do the $8,000 of revenue matched with the total amount of depreciation of 10? Just write off the total cost of the car in 1 year. The reason why we don't do that is in subsequent years we have a wrong profit figure. So taking year 2, we earned $8,000 from using the car, and we used $2,000 of the car, so that's matched up pretty good. But in the alternative treatment, we've got revenues, but we don't have any expenses because we've already written them all off. We're going to get a very wrong profit figure. It's going to be much too high in year 2. Conversely, if we look at year 1, we'll see that our profit figure would be much too low. We've actually got a loss from using the car in 1 year, but then in the second year, we've earned a big profit because we haven't charged any expenses. So what we're doing is better matching revenues and expenses by charging depreciation every year, which represents the amount we've actually used. And the theory that tells us to do that is the reporting period principle, which says let's match all our revenues with our expenses. So depreciation is the second part of that. It's the expense. So we match that with the revenue for each year. Use $2,000, match it with the revenue from using the car. Earn $8,000 from using the car, match up how much we've used, which is depreciation of 2, and each year matching a revenue with an expense. Another theory that tells us that we should be doing this is relevance. It says relevance is about decision making, so wouldn't it be good to have the most accurate profit? Well, the most accurate profit figure would match the revenues with the right expenses. So you can see a net profit of $6,000 and $6,000, and every year we've matched how much was earned from the car, 8, with how much was used of 2 to get a net profit of 6. So in summary, we've got depreciation, which spreads the cost of an asset over the period of time the asset is used to generate revenue. It matches the revenues earned from a non-current asset with its expenses incurred in using it each period. And that enables us to fulfill the reporting period principle and the relevance qualitative characteristic.